This used to be a typical trading day in the stock exchange, and this is what comes to the mind of most of us when we think about stock market. Yes, I know all this can be a bit scary and overwhelming for a beginner investor, but it need not remain that way. Fear comes from ignorance and lack of knowledge. So let's improve our knowledge by answering the 3 basic questions concerning the stock market. And I will do it in the most beginner friendly way. So let's get started. Before I answer those 3 critical questions, let's go back in time. That's too much, they didn't trade for sure. Let's fast forward a bit. The late 1400s. This is Antwerp, or modern day Belgium. It was a center of international trade then. The Venetians brought precious gems from the Far East while the Germans shipped in fur and rye. There were individual merchants and there weren't any companies existing yet. So the merchants who visited the city for trade stayed in the local inns, and the innkeepers started helping them to exchange their goods and sell their products. One of the most important innkeeping families was called the Van de Bosse. Their role in brokering these early economic trades led to the formation of the words Bourse or Bourse in French and German, meaning stock market. And by the early 16th century, merchants were trading less often in real goods and more in notes which contained promises from one person to lend money to the another. This turned out to be a very successful formula and it started spreading to other countries. Now let's fast forward a bit to the 17th century. This was the early stages of imperialism. Britain, France and Netherlands, they were all chartering voyages to the East Indies. These voyages required a lot of money to buy ships, food and arms, and very few explorers could afford them. And then there was also the risk factor. The earliest voyages were highly unsuccessful due to pirate attacks, bad weather and poor navigation. Many ships were lost and the financiers' personal fortunes were seized by the creditors. Put simply, sailing to far corners of the planet was too risky and expensive for any single company. This made a group of merchants to come together and jointly finance all the voyages, so they can raise enough capital and also reduce the individual risk. So instead of investing in one journey, the investors could spend money on multiple companies and limit their liabilities. That's how LLCs or limited liability companies came into existence. These early companies lasted only for a single voyage. They were then dissolved and for the next journey a new one was created. The things changed in 1600 when Queen Elizabeth I issued a charter with exclusive trading rights to a company called Governor and Company of Merchants of London trading into the East Indies. This was the famous East India Company, but without having a centralized place to sell and buy these investment documents, they always had to track down a broker and carry out a trade. So these traders decided to meet in the London coffee house and use it as a marketplace. Eventually, the coffee house stopped serving coffee and changed the name to London Stock Exchange. And those investment documents in paper were the first stocks. Today, virtually every country in the world has its own stock market. And stock market investment would continue to be one of the most popular investment options because of the high returns in the long term. You cannot simply avoid this if you want considerable profits from your investment and let the money work for you. Being said that, now let's answer the 3 basic questions related to trading in the stock market. What we essentially buy are stocks or shares, and those are stakes in a particular company. And by being a shareholder of the company, you are ideally owning a slice of the company. But why do modern companies issue stocks in the first place? Let's see a typical path a newly founded company takes with the help of a simple story. There was this guy, let's call him Steve, who had a brilliant business idea. So he teamed up with one of his best friends and decided to start a company to turn his idea into a product. But like everyone else, he was hit by the common beginner problem: where to find money. And like everyone else, he digs into his personal savings. And with that money, he managed somehow to get his business off the ground. Steve rents out the basement of his house and starts his small production unit. The products were well received by the people and the demand started to increase slowly. That meant the company has to move out of the basement into a bigger production unit. But Steve didn't have enough funds, so he started searching for rich investors to invest in his company. Luckily, he found someone who agreed to invest in the company in return for 1/3 of the ownership. These individuals who provide financial backing for small startups or entrepreneurs are called angel investors. Coming back to the story, with this extra money, Steve could now build a production factory and spend more on marketing and design. The products just got better and the demand kept increasing. And now Steve wanted to grow his business further and expand to other countries. And that meant more money was required. And this was much greater than what a single angel investor could provide. So Steve decides to get money from a large group of people or the common public. And for that, Steve divides the company ownership into many small units and sell them for a base price. The base price of a unit was set based on the general perception about the company, the market demand, and the supply. This step is called the initial public offering or IPO. Anyone who buys 1 unit of Steve's company will have 1 by nth ownership in the company. And by doing so, Steve could also reduce his individual risk and spread it among many people. Now the status of the company is officially changed from a private owned enterprise to a publicly traded company. The company raises enough capital, expands its operations and becomes a huge success. Steve is Steve Jobs, company is Apple, and 1 unit of the company is called stock or a share. By owning stocks of Apple, you technically own a part of the company and you get a say in company matters. But it doesn't make sense to own some shares if we don't have any way to trade them. And that brings us to our next question, where? Just like you don't go to a toothpaste factory to buy toothpaste, you don't knock at the company's doors to ask for stocks. The trade happens at exchanges where existing owners of shares can transact with potential buyers. I had already explained about the history of stock market and how it came into existence. The concept is still the same, but all the paperwork has been replaced with digital transactions. You can't just show up at the stock market and pick shares off the shelf the way you select products from your local market. As an investor, you are typically represented by brokers who make the necessary trade on your behalf. Common examples of German brokers are Scalable Capital, Trade Republic, etc. In Germany, most of the trade happens at the Frankfurt Stock Exchange. Similarly, the New York Stock Exchange is the largest one in the US. Trading hours are normally fixed and starts around 9 to 10 in the morning and go until 4 to 5 in the evening. No trade happens on the weekends and the markets are closed. But what exactly do they do in the stock market? Who manages all these transactions? That brings us to our third question, how? The most common way a trade happens in a stock exchange is through an auction. Buyers and sellers place bids and offer to buy or sell. A bid is a price at which somebody wishes to buy, and an offer is a price at which somebody wishes to sell. When the bid matches the offer, a trade is made. I'm not going into the detailed explanation of how the prices are set, but just know that it's a role of stock exchange to coordinate and adjust the bid and ask prices. So when you buy a stock on the exchange, you are not buying it directly from the company. Instead, you are buying it from someone who already holds it and wants to sell. Let's go back to Apple. You are a beginner investor who believes in the company's prospects and want to invest. Since you can trade only through a broker, you log into your trading account and place an order for 10 shares at the current market price of $100. Once your order hits the market, the stock exchange tries to find a seller who is willing to sell you this 10 shares of Apple at $100 each. The seller could be one person willing to sell the entire 10 shares, or it could be 10 people selling 1 share each, or 2 people selling 1 and 9 shares. It doesn't matter. The stock exchange ensures that the shares are available to you as long as there are sellers in the market. And once the trade is executed, the shares will be electronically credited to your account. Likewise, the shares will be electronically debited from the seller's account. And that's how the stock market works. But how do you make money out of shares? As the company starts to grow and make profits, so does the value of your stock. Suppose the price of 1 share of Apple reaches $150 in a year from its current value of $100, then the value of the 10 stocks you have becomes $1,500, and you make a $500 profit if you sell them. This is how you make money in the stock market, by selling a stock at a higher price than what you purchased. The catch here is that no one can guarantee that the value of the company will increase over time. It could easily go down, thereby reducing the value of the stocks you own and your investment. Is buying and selling stocks the only way to make money in the stock market? No. There are also other options for you as a beginner investor. That's why you have to watch this video in the series where I talk about other trading possibilities. And for more informational content and practical tips, do subscribe to the channel. If you have any questions, post in the comment section below and I will try to answer them. Until I see you in another video, stay safe, stay happy, bye.